Common Sense Investing Part 6, Case Study. Here in this video we will be analyzing Colgate-Palmolive through each of the parameters discussed in previous videos. Rule 1. Does Colgate produce a product which will have continued and rising demand? Yes, Colgate does produce oral care products from 1873 and it is expected to produce the same for many more decades as technology cannot have influence on sales of Colgate. Rule 2. Does Colgate produce a product which is non-durable and rapidity of turnover is high? Colgate does produce oral care products which is non-durable and the durability comes down when consumed more, which increases the demand too. The demand also increases with growth in population over the years to come. Rule 3. Is Colgate a durable competitive business with economic moat? Colgate belongs to a sector of healthcare which is a durable competitive sector. The consumers buy the products based on the quality of the product offered by the company. Colgate does have an economic moat, having more than 50% market share in India. Colgate has a good brand name, trust and goodwill, which has developed a moat for Colgate which gives an upper hand over its peers. Rule 4. Financials of Colgate. Here are the 5 key financials to look for in the financial statement. 1. Growth in sales. 2. Growth in net profit. 3. Consistent or growth in net profit margins. 4. Low long-term debt-to-equity ratio. 5. Consistency or growth in return on equity. Breaking down the financials of Colgate-Palmolive India. Sales. The sales of Colgate India in 2006 was 1,072 crores, whereas in 2015 Colgate manages to sell products worth over 4,000 crores. Over a period of 10 years Colgate has managed to increase its sales by 363%. This indicates that Colgate has consistent demand for the product. PAT, the profit has grown from 140 crores in 2006 to over 550 crores in 2015, growing over 392%. The sales of Colgate has gone by 360%, whereas the net profit has gone up by 390%, indicating that the company has managed to improve its profit margins. Net profit margins. In 2006 the net profit margins stood at 12.6%, whereas in 2015 the profit margins are at 14.5%. Colgate has managed to maintain an average margin of 15.7% over the years. Therefore, when it comes to margins, Colgate has been able to maintain consistent margins without any reasonable contraction. Debt-to-equity ratio. Colgate is a company with zero debt on its balance sheet, hence the debt-to-equity ratio of the company is nil, which is as low as it can get, with company having to pay no interest on its debts. It does have its impact on the profitability of the company. Return on equity, ROE for Colgate has increased from 52.09% to 89.51%, offering a pretty high return on shareholders' equity. Lastly, the effect on the stock price of Colgate. In this stock chart of Colgate, as one can see, there is consistent rise in the stock price, which is the result of good long-term prospects and good financials. In 1980 Colgate traded at $0.72 per share. In 2015 the stock trades at $70.8 per share, constituting a 9,700% increase in the stock price, with 14% compounded annual growth. That is much higher than return obtained from other assets. Here we come to an end of this series of videos. Please like and subscribe. Thank you.